And you talk a lot about in Shareplacity too, which is an excellent book, and I'd encourage our listeners to check it out, about different lessons that people can learn about investing in international markets. And I'd love if you could share some of those with our listeners, and maybe some examples or strategies to illustrate each point.
Yeah, it's really, really good question, because you often hear everybody saying, oh, it's time to buy Europe, so cheap, or Japan's coming back, and there's going to be a new government and they're going to start spending, and Japan's the place to go. And oh, but China, of course, we have to buy China because it's the biggest growth engine in the world. 2 points is I do have some charts that I can actually show on this, but the first point I wanted to make, when we did global emerging markets, it's really important to understand that no single investor can possibly stock pick across the globe. Okay, so I'm never ever advocating you as an individual investor should say, I'm going to buy that company there, that company there, that company there. It is like, that's way too hard. Even if you look at the likes of Magellan and Charlie Aitken that try and do that, it's a higher risk strategy to selectively pick, 10 companies from around the world. So how we used to do it, doing global emerging market strategy, the way I would approach it, you either do it from a macro point of view, so you take a top-down approach, and in emerging markets, it's always like GDP is growing so rapidly and they've got an emerging middle class and it's going to grow a lot faster than the mature economies, therefore you invest there. Alternatively, and this is my preferred, is you look at sectors and themes. And sectors and themes are a much easier way to ride a growth wave. So I would say to people, don't try and stock pick globally. I don't have an issue with stock picking in the US if you are so inclined, but I wouldn't say start going off and trying to pick, just buying Taiwan Semiconductors over in Taiwan, and then you buy, Toyota in Japan or SoftBank or something like that. I just think that's a recipe for giving yourself a nervous breakdown. But if you do want to look at themes, I think that's a great idea. And that is something that we will come to, and the book discusses a lot. But I'll just quickly show a couple of charts, if you don't mind. In terms of, is my little...
For anyone that's listening to this, Danny is sharing her screen.
Yeah, I just wanted to...
PowerPoint slide too. Got it going on.
Yeah, no, I just wanted to go back. Okay, so... This is from BCA, and I was very privileged to actually be able to see this presentation. But basically, for those that are listening, people love to talk about emerging markets as being the place to put your money. I hear it so many times. I spent 8 years of my life broking emerging markets to major funds in the UK. And whilst I was lucky when I did it at a great time, the charts that are currently up are really interesting because they show that the economic growth does not necessarily translate into equity returns for the markets. And if you can visualize, it does the real GDP per capita for Korea, Taiwan, Singapore, versus the US, for example, and the GDP for China and Vietnam. These are all countries that everybody has, global emerging markets have investors have gone to. But you see, if the chart goes more or less from left to right, GDP growth happening, but then you look at the long-term share market performance, it's been dreadful. It's highly cyclical. It goes up and down. And basically, they have not one single, according to BCA, emerging market has outperformed the developed markets consistently over the last 40 years. So the reasons why are things like you don't have the transparency, you do not have the governance, you have major families that control a lot of these companies that are not only always working in the best interests of the stakeholders, but also too, I think we've seen something of sovereign risk that started to emerge with what's going on in China. Now, I do know a lot of people and fund managers like to invest in China, but I think for me, it is my investing experience there is just a disaster. I owned the ETF in the US KWEB, which is quite a well-known one, and it kind of doubled. And silly me thinking, oh, I should really sell that. Before I knew it, Xi Jinping's cracking down on all the major companies, and the thing halves overnight. And I'm like, oh, I'm probably going to sell it at the bottom. Sure enough, I sold it at the bottom, but I'm still not unhappy with that decision, because it's a bit like buying cyclical companies. You've really, really got to pick the upswing when the markets do rally, because it's not like buying the S&P, which does go up and down. But if you were to look at the chart, it starts at the bottom on the left-hand side of the chart and steadily works upward to the right-hand side of the chart, which means you make money. Another example is just if
Danny, can I ask a question just on this?
Yeah,
because
sure.
It looks like you've got basically two lines. One shows GDP, which is the growth of the country's economy, not like going up pretty strong. And then you have the stock market not going up nearly as strong.
Yep.
Is this why you're saying that you don't necessarily use this as kind of an indicator to help you invest? Is that why you're saying, and then you prefer to focus on secular themes instead?
Yeah.
Okay.
Yeah.
Cool.
I think the reason why people buy the likes of emerging markets is because they have been, like China, one of the high growth engines of the world. Okay.
That doesn't necessarily translate.
Not into stock market performance. Probably a better way to have played that would have been buying Apple, Nike, Estee Lauder, LVMH. You'll hear a lot of fund managers talking about, in my day, they'd buy Unilever. Okay. So if you want to play the likes of the emerging markets, you can do it through multinationals, because they sell into those countries, for example. Whereas if you were to go in and buy an Indonesian bank, you are taking a lot of risk on board, for example. That's not to say there aren't good companies in emerging markets. There are, but inevitably you're taking on more sovereign risk, more political risk, risk of, obviously the pandemic has proved to be really, really problematic in emerging markets. Vietnam's had to close down all the manufacturing facilities, and you're seeing supply chain problems for the likes of Nike. So I think in terms of what I'm saying to people is that if you invest overseas, don't make it too complicated. It's not like you have to be in emerging markets. It's not like you have to be in Japan. It's not like you have to be in Europe. And there was just another case here of, this is just a chart. I didn't do it again. It's BCA, and it's just basically showing that you've had really, really poor performance out of particularly European financials and Japanese financials, their banks. And a classic case in point of when you're listening to, we'll get to this when we discuss kind of things to learn when you invest, but we were told like Japan was going to be the growth engine of the world in the late 1980s, and they were building golf courses and this, that, and the end. Of course, it spectacularly blew up, and we all know the story after that. And you know, it's a company, a country that has aging demographics. They've got big, you know, structural problems. Europe is similar, and why people say buy Europe is because it's cheap. Okay, it's cheap on a PER basis, but it doesn't necessarily mean you should go and buy it. And so I think that's really just what I was trying to show in these, that you have to be selective. And I'll get to where you are selective in a second. Now, what was the other question? Oh, where you can buy some examples of international in Australia. This is not a buy recommendation to everybody, but I just wanted to give a really good example. So there's an ETF called QUAL, and it's the Van Eck Vectors MSCI World ex Australia Quality ETF. And that has a reasonably low expense ratio of 0.4%. It has a dividend yield of almost 1%. And funnily enough, if you look at the top 10 holdings in it, it captures a lot of those big US, what I call value growth stocks. So Microsoft, Apple, Alphabet and the like. So there is a case in point where you don't actually even have to go buying US dollars, setting up a US dollar trading account. You can actually buy an ETF in Australia, which will give exposure to some of those secular themes that we might start to touch on.
Yeah, that's really interesting, because I think I saw a question come through from a listener the other day, and they were talking about the FANG, Facebook, Apple, Amazon, I'm probably going to forget the rest.
That's all right.
Companies, and whether they should actually, because there was so few in there, should they buy each one of them individually, or should they buy one of those ETFs that focuses on those major US companies?
Yeah, that's a really good question. I think you need to know the companies quite well. You know, for example, they've all got exposure. Okay, I'm not a big fan of Facebook personally. I don't own it. I don't really want to own it. I don't really like the company and kind of what it stands for. We're yet to see whether Zuckerberg's metaverse is going to take off. I think there are signs that the omniverse, which is kind of working, is an environment where you can work in a 3D capacity in a virtual world as a company. So architects are doing it, car designers are doing it, etc., and it's all done in the cloud. When you look at the other ones, you've obviously got Amazon. You could question how much more is going to come out of the retail side of the business, but AWS is a huge growth engine. Okay, the cloud services businesses. You've got a transition of the CEO there. So some people are saying, well, Bezos is gone. Is that the end of the company? Personally, I don't think so. But I think at the moment, going into the type of cycle that we are with potentially rising costs, due to the pandemic, supply constraints, higher energy costs, they might have possibly some issues around whether their sales slow down or whether there's pressure on margins. Microsoft and Alphabet, Google in particular, seem to come out as the two chicken dinner winners in this kind of sector, basically because Microsoft very much is geared into, it obviously has the SaaS revenues from its software business. It has an amazing cloud business, Azure, which competes heavily with AWS. But they also have their fingers in a whole lot of other pies, and it's perceived as more a value growth stock. So you're not buying an expensive software service like Atlassian, by way of example, which is a lot more expensive and doesn't declare any profits. And then the Google story is very compelling because you've got a major search engine, you've got a huge growth hub in advertising, and you've also got the emergence of YouTube, which is proving to be an incredibly profitable advertising/streaming service, which may come and compete with the likes of all the other streaming businesses, which are also held in the likes of Apple and also Amazon. So I guess the answer to the question is, it's up to you. You can potentially own them indirectly, or an ETF will serve that purpose as well, but you will capture more of them.